Lack of consistent strategy. How to build a trading strategy that actually works. Consistency in trading is often what separates successful investors from those who struggle to reach their financial goals. A lack of strategy often leads to erratic results, emotional decision-making, and missed opportunities. This video is a step-by-step guide to building a trading strategy that is not only effective but also repeatable, helping traders achieve long-term success. Have you ever entered trades based on a gut feeling or exited positions too early due to panic? Lack of consistency in decision-making is one of the largest culprits behind poor trading outcomes. Emotional trading, driven by uncertainty and fear, can derail even skilled traders. In this video, we'll identify the root causes of inconsistent trading and understand why having a clear, structured plan is essential for combating these pitfalls. Without a strategy, traders are left navigating volatile markets blindfolded, reacting to every market fluctuation without a steady course. Before diving into tools and methods, every successful trading strategy begins with a solid foundation. Here are the key elements. Define clear goals. Start by outlining what you want to achieve through trading. Are you aiming for steady short-term profits, building long-term wealth, or experimenting to gather market experience? Each objective shapes the rules and approach of your trading system. For instance, a day trader may focus on quick entries and exits, while a long-term investor prioritizes sustainable growth over years. Establish realistic timelines. Goals are ineffective without realistic timelines. If you're expecting significant results in a short period, you may jeopardize consistency by making rushed decisions. Break down your objectives into practical timelines, which will keep you motivated and aligned. Understand your risk tolerance. Knowing your personal risk tolerance is another vital foundation-building activity. Risk tolerance defines the level of price movement you can mentally and financially handle without reacting impulsively. Traders who overextend themselves often end up making emotional decisions when markets turn against them. The backbone of any trading strategy is the ability to analyze the markets thoroughly. There are two popular analytical approaches you should combine for a balanced perspective: technical analysis and fundamental analysis. Technical analysis. Technical tools let traders predict potential price movements by examining patterns and market data. Some popular tools include moving averages and the Relative Strength Index, RSI. For instance, moving averages can help identify upward or downward trends, guiding the ideal timing for entering and exiting trades. Similarly, RSI highlights whether an asset is overbought or oversold, signaling imminent reversals in market trends. Fundamental analysis. On the other hand, fundamental analysis looks at the big picture by evaluating the intrinsic value of assets. Metrics such as revenue growth, profitability, and macroeconomic trends are critical for determining an asset's potential long-term value. This is especially useful for traders interested in holding assets for more extended periods. The combination of technical and fundamental analyses sets you up for multifaceted decision-making, reducing errors caused by reliance on any single tool. Once you've built a strong foundation and mastered the basics of analysis, the next step is to create a clear and actionable strategic framework. This framework consists of predefined rules, guiding when to enter and exit trades, protect profits, and minimize losses. Set rules for entry. One of the biggest challenges traders face is knowing when to enter a trade. Using technical indicators like support and resistance levels or crossover signals from moving averages can provide reliable entry points. Define the conditions that must be met before initiating a trade and apply them consistently. Establish exit strategies. Equally important is knowing when to exit a trade, both when it earns profits and when it risks losses. Without defined exit rules, traders often fall victim to greed, staying in trades too long, or fear, exiting prematurely. For example, a simple rule may be to exit when the RSI signals that an asset is overbought. Leverage stop-loss orders. Stop-loss orders act as safety nets for traders. These orders automatically sell assets once they drop below a specified price level, preventing catastrophic losses. Setting realistic stop-loss levels tailored to each trade reduces financial damage while instilling discipline. Profit-taking strategies. What happens when a trade performs exceptionally well? Without clear plans, some traders might let profits disappear, waiting for never-ending uptrends. Consider strategies like setting target prices or adjusting stop-loss levels upwards as prices rise to lock in gains. The best strategy in the world won't work without consistency. Many traders build strategies but fail in consistent execution due to emotional biases or impatience. Here's how you can stay on track. Stick to your rules. Once your entry and exit rules are defined, it's crucial to follow them rigorously. Deviating from these rules, whether due to panic during sudden market dips or FOMO, fear of missing out in surges, negatively impacts long-term outcomes. Overcoming emotional trading. Trading decisions should be driven by facts, not emotions. Take steps like trading with smaller amounts initially or using simulation accounts to minimize anxiety. Regularly revisit your strategy to remind yourself of the reasoning behind your system. Practice patience and discipline. Success in trading is cumulative. Gains compound gradually. Just like investing in other areas, patience and discipline separate those who thrive from those who flounder. Avoid rushing into trades or expecting every trade to result in immediate profits. Markets are fluid and constantly changing. It's a mistake to think that a one-size-fits-all strategy will always work. Periodic refinement of your trading plan ensures relevancy and continued success. Monitor and analyze results. One of the essential practices in trading is tracking your performance. Use a trading journal or digital tools to log entry, exit points, profits, and losses. This self-reflection helps identify patterns, strengths, and areas for improvement. Adjust for changing markets. Market volatility, macroeconomic shifts, and industry trends can impact the effectiveness of strategies. Be prepared to make thoughtful adjustments, but avoid overreacting to every minor market fluctuation. Incorporate feedback loops. Evaluate past trades and the decisions behind them to learn from both wins and losses. For example, if a stop-loss level was repeatedly triggered unnecessarily, consider whether the value margins were too tight. Feedback loops keep you in a constant state of learning and adaptation. Every professional trader emphasizes the importance of managing risk. A successful strategy doesn't just focus on profits, it minimizes downside exposure. Diversify your portfolio. Never put all your capital into a single trade or asset. By spreading investments across diverse markets or industries, you reduce overall risk and avoid being overly reliant on specific outcomes. Control trade sizes. Especially if you're new, avoid overcommitting large amounts in individual trades. Starting small ensures that one mistake won't deplete your account, allowing you to live to trade another day. Set failure limits. Decide beforehand the amount you're prepared to lose within a specific period, whether daily, weekly, or monthly. This creates a psychological safety net and prevents revenge trading, where losses lead to impulsive, high-risk trades. Theory becomes impactful only when it's applied effectively. Here are some practical steps to turn strategy into action. Start small. It's always better to begin with smaller amounts. Gradually scale up investments as you become more confident and experience measurable success. Practice on simulation platforms. Before risking real money, use demo trading accounts to test your strategy in real-world conditions. This builds confidence and helps refine your approach without immediate financial risk. Use technology wisely. Leverage trading platforms, alerts, and automated tools to execute trades more efficiently and ensure adherence to your rules. To summarize, a consistent trading strategy is built on a solid foundation, thorough analysis, and disciplined execution. By defining clear goals, integrating technical and fundamental analyses, and maintaining rigorous application of your strategy, you set yourself up to achieve steady growth over time. Remember that no strategy is static. Continuous refinement and adaptability will allow your approach to thrive in ever-changing markets. Trading success requires effort, patience, and practice. While challenges are inevitable, sticking to a structured plan empowers you to reach your financial goals and become a confident, disciplined trader. Commit to the lessons here, trust the process, and watch your potential unfold over time.